Okay, welcome back to part 2 of chapter 2. We are on slide number 10, continuing on from where we left off, talking about the qualitative characteristics of representational faithfulness and relevance. Now, there's some qualitative characteristics besides the main two that enhance the information. Comparability, you'd like to be able to compare from business to business, from year to year. Verifiability, knowledgeable, independent users achieve similar results. Timeliness, you can't wait a year to have something evaluated before you do your statement of financial position or balance sheet, so it has to be timely. And understandability, now this is interesting here, users with reasonable knowledge. So we expect in a set of public financial statements, the investors and other users to understand financial statements. But we have to present it. 11. It's not possible to always the two main qualitative characteristics plus all the sub ones. There's actually a trade-off between them. Think of relevance and representation faithfulness. Okay? So, let's say you bought land 20 years ago. What's it listed on your books at? Well, it's listed at cost. Well, what's happened to the price of land in the last 20 years? It's gone up, right? Significantly. So, for a decision maker, the relevant information would be the value today. But the number that you can actually prove 100% would be the original cost. So, we ask ourselves as accountants, do I keep the cost as the value, or should I be showing the value today? Well, there's problems with both. The problem with the representational faithfulness is it's accurate but old. The relevance, it's useful, not 100% correct. Because if I asked all of you, let's say you were all evaluators, okay? And you all went out and looked at a piece of land or a building or whatever, an asset. Would you all agree 100% to one number? No, you'd probably have different values. And do the values change? Yeah, depending on what the economy is doing, especially now in a state of disruption, it would change a lot. So, there's a back and forth trade-off. More accurate, but old, so not as useful. Useful, but not 100% correct. So that's what they talk about when they talk about trade-off. And we'll talk about that as we go through each of the chapters. Okay, it's just so weird, you guys, not being able to see all your faces. Also, as I mentioned earlier, cost-benefit. The benefits should outweigh the costs of that information. For example, go back to our little stapler example. We'd have to amortize it yearly for 15 years. Is the benefit of the number spread out over 15 years for a $30 stapler more than the cost? No, because someone's actually got to track this, and the benefit is pretty much nothing. Because $30 over 15 years is $2 a year. Does that make sense? Now, actually, this cost-benefit relationship is the reason they are going simpler standards for private entities. The other reason is that for private entities, the shareholders are closer to the business and operations. So they'd know more of what's happening. And so it would be easier to follow, keep track of how they're doing, and so on. Okay, so that's the qualitative characteristics. So now we're going to move here to the other part of the triangle, which are the elements. Now you will be happy to know you learned those all already last year, and it's just a little review in case you haven't it all. The basic elements of the financial statements. Assets, things you own or are worth something to you that you have title to or are entitled to. Liabilities, what you owe. Equity, the owner's portion. Revenues, or what you earn. Expenses, the costs incurred. And gains and losses. So I'm just going to go through all the next slides, define them. We're just going to skip through them pretty fast because I want you to read them on your own. You've already been exposed to it, so there isn't anything really new to throw in. So slide 13, we're talking about assets. And read this on your own. Make sure you focus on the fact we have a right to it as opposed to physical asset. For example, if we have goods on consignment somewhere, at a consignment shop, they go on our statement of financial position or balance sheet. So, and this is statement of financial position, and it's the same thing. And I'll use them interchangeably. So those are the assets. On slide 14, it talks about liabilities, and you can read that. And same with slide 15, you can read about equity. On slide 16, I want to talk a little bit about this. Revenue, expenses, gains, and losses. Of course, that goes on the statement of income or income statement. And we know what revenues are. We've got increases from ordinary operations, so you do some work. Expenses, decreases in economic from ordinary revenue generating activities. Gains and losses are unique because they come from an entity's peripheral or incidental transactions. So, what we mean here is, let's say you're Canadian Tire, and you sell, I don't know, patio furniture. I guess I'm hoping it gets warm again. You sell patio furniture. That's revenue and cost of goods sold, because that's your normal business. But let's say you sell your computers from the office. You're getting new computers, so you sell your old ones. Is that your regular, ordinary revenue generating activity? No. That's an incidental transaction. So there will be a gain or a loss on sale. So, incidental just means it's not part of business activities, regular business activities. So, just wanted to draw your attention to that, because that is one thing that students sometimes get hung up on. They're not sure where it goes. Okay. Slide 17. Items included in the financial statements. So IFRS, Statement of Financial Performance. Which is also the income statement. Statement of financial position. So you know what, we're not going to use that breakdown up there. We're always going to use income statement because it'll be. Or balance sheet. Statement of changes in shareholders' equity. Statement of cash flows. So it doesn't really matter what you call it. They're similar. Only thing is, under IFRS, at the bottom of the balance sheet or as a separate little section, and we'll talk about this, you guys, as we go through this course. You have other comprehensive income, OCI, whereas in ASPE, OCI does not exist. And we'll talk about that later when we're actually dealing with it. Okay. So that was slide 17. Slide 18, foundational rules. You can just read these. And on slide 19, they list them. So you have learned pretty much all of these in your first year. With maybe not this one and maybe not that one. But we're going to go through them quickly and talk about it. Now, before I do, you will see the standards, which you can look up online. And they will tell you how to recognize or put it on your books, on books. And derecognition is off books, or take off books. Measurement is how to measure it when doing financial statements. Financial statements. And presentation disclosure is info you give in the notes or elsewhere. Sorry guys, I haven't really written for 4 months. My writing is a little bit rough. Okay, and I'm going to stop here and start part 3 in a second.